Welcome to today's Corporate Venturing Insider series. Today, I'm very happy to have Jody Thelander with us, and I know she's going to share a lot of things that most of you are curious about. Jody, welcome.
Thank you, Nicholas. Glad to be here.
And so I was recently on your podcast, so this was really nice. Thank you again for inviting me. So, Jody, I always start by asking how someone got into corporate venturing. You are right in the middle of it, so maybe you could share a little bit of your background.
Thank you. It's actually a very step-by-step process. So I was in San Francisco, and it was really the go-go.com days back in the late 90s. And my firm was doing compensation for private companies that had raised venture money. But I noticed that all of the good stuff was going on in the boardroom. So that's where the first sort of Thelander surveys and consulting started. And then from there, because we worked with all the VCs, it was a natural question, especially with my colleagues who are also my friends. It's a nice group of people would ask, what about my salary increase? What about my bonuses? What about these other factors for venture capitalists? And there wasn't really much of a career track that way. The VCs were this formidable group, but it was becoming more and more a career trajectory. So started doing the comp surveys for the VCs. And then I noticed that several of my VC friends were going to corporate venture firms. And that was the next, what's a CVC and what kind of compensation do they have? And it really all just begged the question around getting into formalizing, as you and I have talked about, corporate venture as a career track and allowing the ability to compare and contrast. But it seemed really important to make sure there was infrastructure.
I think you've had the chance and the opportunity to see the rise of CVCs. I think you were a friend of the GVC for a while. And my understanding is it was a very small conference to start.
Yeah, James Mawson and Heidi Mason, Bell Mason Group. I know Liz is now in charge and does an amazing job. And of course, GCV is amazing as well, a great infrastructure and organization to support the industry. And we collaborated with them and the law firm DLA Piper at the time. And we sat in a boardroom at DLA down in Palo Alto and really talked a lot about what we just said, right? We looked at the venture data and the jobs, and we crafted the first comp survey to look at, I think at the time it was like 3 or 4 roles: the CVC unit leader, a senior investment professional, and then some version of an analyst. And we assumed like the CFO and the other jobs would be coming from the parent company. And we thought it would be so important as the other components, like the consulting and like Bell Mason does, to put a CVC together, and what GCV does for all of the players coming together, that the last component that we could help with. And obviously we had some insight in, because we only cover the private capital market. So we don't do any work that covers like a traditional public company consulting compensation. So it was a perfect segue. We knew the other lanes that we wanted to compare and contrast to.
And I think part of it is reconciling two things that seem so different. You have VCs and you have corporations. It nearly reminds me of the book Men Are From Mars and Women Are From Venus. And one is about predictability, distribution law. One is about high returns but high risk, which is a power law. And compensation is very difficult to find the right match between the two.
You know this better than anybody, and I love your optics on it because you're very strategic. You're both strategic and tactical because you understand the big picture, but then obviously adventures, you do this every day as well. You're really a leader in the industry that sets a tone, because that's what people want to know. What's the best way? What way makes sense? And the truth of it is, as well as I do, there's not just one way. And it depends on what the goal is of the CVC and what type of team and what the parent company wants, because everybody wants something a little different, versus VC, where I could say without a shadow of a doubt, everybody wants financial return as their number one priority. They may have some double bottom line, but no question, financial return is the biggest motivator.
Yes. So if I go back to the rise of CVCs, what do you think is the biggest change you've seen from even 10 years ago when it was starting to become something with GCV? And I think GCV is going to be doing their 10th event. So 10 years ago is probably the
Right.
right metric to today. What comes to your mind when you think about the big change, the high level changes?
The formality of the compensation and even just the role that CVCs play in the innovation ecosystem, and also wanting to be competitive. Some CVCs really want to be competitive with venture firms and have that true, I don't want to get too technical, but get into those long term incentives like carried interest. And so it's become very formal and structured and competitive.
And part of it is also the number of job titles we discussed. So maybe this is a plug. We will put the link to the webinar we had last week. But part of it is the number of job titles, inflation we've seen in the last 10 years.
Yeah. I mean, there used to be, as we said, just a handful of titles. And then the CVCs were very smart to leverage the resources of the parent company. And this is something that you're obviously very familiar with. But for those of you that are listening, the strength of the CVCs is that whole business development role and optimizing the parent company's skill set and talent inside to the portfolio companies, because we know now that the private markets are staying private longer. It's harder for private companies to raise capital. It's harder for VCs to raise new funds. And the CVCs are in a very optimal position because they're the slow and steady wins the day.
I like that. Can you double click on this? Because I think there's a golden nugget behind.
Yeah, the CVCs have, because of their comp structure, has a couple of possible components for the long-term incentive. One is corporate stock.
Hmm.
And another thing could be the shadow or phantom or some version of a synthetic carry. And then the other could be a true carry. But with all of that, nothing is happening fast, even for VCs, right? The carried interest vesting times now are heading up more than 10 years. I think CVCs probably always knew this if they were not on some fast track, because in some respects they had to be careful that the CVC person, the top person or the whole unit, wasn't bringing in more returns than the actual parent company, because that sometimes caused a little conflict. It was more about technology transfer and innovation.
Hmm. No, it does make sense. And if you think about career development, so there's compensation clearly, but in terms of career, when CVCs were very early, there was no such thing per se. And if you think about VCs, you don't really have a career development beyond analyst to principal to GP. But in CVC, it feels like there is many more paths, and you have platform teams on top of investment teams. So you do have quite a few differences that are quite fundamental with CVCs. How do you think about not just the investment team, but the rest of the team for a CVC?
It really depends on the CVC, because typically the investment team is more goal oriented in terms of selecting the portfolio companies and understanding the directive from the parent company, or if they're very separate from the parent company, they're structured that way, what they're trying to achieve. And as you would imagine, the lower down you get in a CVC, the less impact they have on that strategic goal, and they're more tactical in terms of the day to day. So they're less focused on that long term incentive.
And I want to double click on the tactical versus strategic. And most of the audience are already in CVCs or thinking about starting a CVC. So let's focus on those who would be thinking of starting a CVC. What do you think is a top tactic for them to think about? And what is a top strategic goal they should be thinking about?
Yeah, and I feel like from our work on the consulting side, we've seen many iterations of it, right? We've worked with CVCs in the beginning, and then when they see that they had the right idea, they changed their strategic perspective a little bit, or vice versa. They came in thinking one thing and that was not effective, so they had to move in a different direction. So I say that for those that are starting out, it's okay to take it step by step, because you have to be agile and you have to be able to pivot. Listen, we see this now, the markets have changed even from 10 years ago or 5 years ago, so the firms might have to readjust. But overall, I would say to try and build this, we talked about this on the webinar, go slow and really think about what your mandate is and make sure that your compensation structure is aligned with that, because it's very important to plan out as much as you can ahead of time.
I think there are two golden nuggets in what you just said. One is take your time. It's okay to make mistakes. Try to go step by step and iterate. But one is what worked 10 years ago or even 5 years ago may not work today because the environment is so different.
Yeah, and even the VCs have this, and their portfolio companies have this. So it makes sense because you're not acting separate from the whole investment ecosystem, you're part of it. And so, despite the fact that compensation is a little bit different, the whole investment view and optics on this have to be flexible, because who would have thought that the fundraising would be so difficult, or that the AI innovation, and there were times where it was other areas that were extremely hot. We always track where there are pay premiums and what jobs are paying more. And you can imagine that AI within CVCs and VCs is definitely coming up as a question. But years ago, we never had these questions and we never had those job titles.
That's true. Actually, we just started with a full-time intern for 1 year just about efficiency and AI tooling. So I think it's coming. Yeah. I need to give a disclosure, which is I'm a happy customer of Thelander. So what I'm going to say is probably going to be important for the audience, which is when you start a CVC, it's very hard to actually understand the compensation of a CVC. Part of it is because you're part of a VC ecosystem. Part of it is you want to incentivize according to the right goals. What would be your advice for someone who needs to explain compensation to a mothership who has not ever done a CVC? So they don't really understand the carry model. What would be the tips you would give them to explain why it's different and why it makes sense?
It's such a great question, and it comes up all the time. So, corporate HR and compensation is very different than the private capital markets. And I spent 10 years learning this when I went to graduate school and got a master's in human resource. So I really understand where the pressure points are, because if someone had tried to explain this to me when I was early in my career, or I was just trying to master the corporate compensation structure, I would have been hard pressed to understand what all of this means. So I think breaking it down and really understanding what the compensation levers are compared to the traditional corporate stock only, and trying to help educate the parent company or the mothership in terms of what these different compensation levers mean and how they're put in place is really important, and to go slow with it because it is complicated.
Yeah. And there's one thing which I did not expect, which makes sense today, is when I started TDK Ventures, nearly all VCs will start by asking, how do you compensate your team? And clearly, they want to know that to understand your behaviors. But that's something which you have to think of up front, because this is something which you VC ecosystem wants to understand as part of you being a CVC. Can you explain why you think that question is fair game and why it matters to VCs?
In the VC side of the house, there's only reason that VCs get into this is, at the end of the day, they want to make a difference. But tied with the risk is the reward. They typically put money in for their carried interest. So that's why they need to know, because it will dramatically impact their lifestyle. And also, they're investing a long time into companies. And I think on the CVC side, it was acting more like a corporation. And so there were less questions around it, because compensation, I would say, up until the last few years, has been more sort of taboo. But there are many states now that have you need to pay transparency has become more, I think, common and more acceptable. So I think there's more adoption to it.
Yeah. And this is where you have this challenge. So you talked about phantom or synthetic carry,
Right.
which I think is a challenge of trying to look like a VC, but not quite a VC, but something that's actually more manageable and controllable from the mothership as well. Have you seen good examples and maybe good guidance you could give to the audience?
So let's distinguish, though, the difference between, and I'm not a lawyer or a tax accountant, but the true carry means that you get a return on the portfolio, right? You invest in the company and you take equity. And the shadow phantom synthetic carry is some variation on that, where it is can be based on either the portfolio returns or an exit. There are a number of different ways that you could be getting that shadow phantom or synthetic carry. So it's a little bit of an adjusted version down from a true carry model. And I think it's really important. You're asking great questions, and it's important to structure it, because you need to know exactly what you will be owning and how you own it, and what will happen if there's a liquidity. And as we touched on earlier, I don't want to get too confused here, but you have to be careful because sometimes if the returns are so high, that may leave the CVC people in the potential position of making more money than the actual executives or the senior leadership of the parent company. And that is typically, there has to be some type of cap on that because they don't like to see that.
Yeah, yeah. Which is back to that matching between the two worlds.
Yeah.
And I think there is something very different, in my view, between VC and CVC, that VC by design are very stable. Typically, people stay in the same VC for a long time. They have committed their own money. There is a carry that they want to earn. While CVCs could be a transition for someone from an executive. The CEO that maybe they report to could change. The head of the CVC could change. So there are many things that could change. And if it's not captured well, you end up with challenges. So when you say be careful, don't assume everything will work out, maybe one thing is also don't assume that the people who have agreed verbally will be there when it happens.
One is that VCs do have higher retention at the top levels. And we survey this
Mm.
because all these questions that have come up, you know the answers, but it's really helpful, as you said, to have benchmarks and data on that. So we do see that the top investment professionals, like we have 6 levels of investment professional from the senior managing partner down to associate with senior associate and a couple of levels in between on the venture side. And just to say this is that the nice thing about the data that we have is that the VC and the CVC data, while it's 2 separate sets of question, it's on the same platform because we want you and we think it's so important to be able to compare and contrast. We show the vesting times are now over 10 years, moving away from that 5 to 6 years. And in many cases, they even further say you have to be present to win, meaning you don't always take your carry with you. Those are done on a case by case basis. Now, on the corporate venture side, it really depends. And you captured this perfectly, right? Because in some cases, they don't even have a carried interest model. You have corporate stock. So it's harder to tie people to stay because they're not as motivated. So if you want a different kind of longevity and you want lower turnover, then adding in some of those handcuffs that are tied to a vesting time and a carried interest and being present to win, which again, we ask all these questions, then you can. And that's why, listen, the data is only as good as you know what to do with it, because all of this is very tricky and there is no one way to move these pieces around.
And it's very interesting because if you think about VC, it's extremely stable in terms of compensation. You have a base salary. I don't even know if it's the majority have a bonus structure, and then you have a carry. And that's basically it. But if you think about the corporations, you mentioned stocks and of course base and of course bonus, but you also have synthetic carry, and the synthetic carry could be so different between one CVC and another.
Although I have to laugh because if someone's listening to this on the venture side, I'm sure they're like, no, that's not true. Because
Ah, okay.
it really isn't stable on the venture side. Across all VCs are not created equal. And it also depends on what the assets under management are. And it depends on the seniority of the team. And it depends on a lot of things. And it also depends on what your structure is, whether you are very carry intensive or you're cash intensive or you're both. So we work on a lot of VC projects, and I can guarantee you no two have ever been alike. I think the levers are different on the CVC side, and maybe there are more levers to play with. That's the part that's more stable on the VC side, but how they're used, no recipe is exactly the same.
I think it's back to what you said earlier, which is it depends on the goal. And if I was to abstract as much as I can between an exploitation of the current business and an exploration, I think if you're in the exploitation goals, you probably want maybe 2/3 to 3/4 internal recruitment and then some
Absolutely.
with good experience of the venture capital side. And you probably flip the ratio if it's more of an exploration. So you still have a good tethering to the mothership, but you're not biased by what you can't do because the intention is exploring what you haven't done yet.
And also, I totally agree with that. I see the flipping part where most of the CVC comes from the parent company. But then once they start to hire people from outside, whether they hire people from the investment banking or they hire from venture, then they get wind of all the other options out there. And I think it makes a, once that color's in the water, you can't take it out. And then I think that sort of breeds optimism and hope and a little bit of a hunt to be more that way. And I see it flipping too. I don't have exact numbers, but I see that happening because that's where they typically call us and say, okay, Jody, now we want to understand the comparing and contrasting of the two sets of data.
It makes sense. And now, in terms of retention, so you recruit the team, now you want retention. What's the best practice you've seen in terms of explaining it to the team, not to the mothership anymore, but to the team?
I'm a big proponent in transparency and having honest discussions and being knowledgeable on what's going on in the market, why you chose what you chose, and then where somebody is getting paid. Because that sends a clear message. It's not that different than parenting. Listen, we know what the other kids are doing. Here's what we're doing in our family, and here's what you get. So it's, very basic because that way if it makes someone happy and they like that, they can stay. But if they feel like it isn't a representative, this comes up all the time when someone's getting paid very well and they're happy.
No, that makes a lot of sense. I like one thing you mentioned about your product, which is you bundle both the VC and CVC so that everyone gets to see both sides. Can you maybe share the philosophy behind? Because I think that's very profound.
It's so important. Well, we started, as I said, doing the VCs. And by the way, on the VC side, I think we started with 10 or 15 jobs, and now we're up to almost 80 positions, similar to
Wow.
what's happened in CVC. But the ability to compare and contrast is really important because you can't just go through this with blinders on. You got to know what's going on around you. And then you make your decision about what makes sense for you.
Yeah. I know that when we designed our compensation model, I was very clear that what I was worried about was to lose my team to deep tech tier one VCs. I wasn't worried about CVCs per se. I was more worried about VCs. And to have a view of not just CVCs compensation, but VC compensation was really important.
Yeah, it is.
I'm going to challenge you on thinking about two different paths. Someone in a VC thinking about joining a CVCs, what are the pros and cons? And then I will ask the vice versa.
If someone in a VC is looking to have impact and have more resources, that's where I think a CVC and that the fundraising may have gotten harder and that they're with a VC firm that is maybe at a certain asset under management asset class it's a little smaller and they want to have more opportunity and see a bigger picture in terms of the strategy and incorporating the skills of the parent company, that might be an opportunity for them.
I love that answer. I think that you're right. It's about potential for impact, taking the resources which you don't typically have in a VC, and being able to bring so much more superpowers than you would typically have. I really like it. Now, if you're in a CVC and you're thinking about joining a VC, what would be the pros and cons you would make?
I think you probably have learned a lot in your CVC, but now you really want to have, you feel comfortable about your investment strategy and you really want to have skin in the game and you want to have just a true cash and carry and you are happy to contribute capital and you want to really be on that with maybe a firm that has had a track record of success and you've had successes, but your compensation maybe has some boundaries in terms of how far much you can participate in that and you're ready to go.
Very nice. So, Jody, my last question for you would be more about your hope for the future. How do you see the CVC's professionalization moving forward? How do you see the impact it can bring to entrepreneurs and to their mothership?
I mean, it's all moving forward. CVCs have done a great job and they continue. We have the pleasure of working with many, especially like relationships like yours, Nicholas, that have been a long term, right? It's been since this all started. We remember each other from 10 years ago. So I imagine in another 10 years, we're going to know and see even more. And CVCs are going to continue to be a very important part of the investment ecosystem and the innovation and that end-to-end solution that they provide to portfolio companies is unparalleled. And I think that we're going to continue to see that the CVCs are coming up with even more innovation and faster because they're going to extract from the parent company.
All right. It sounds like you're very bullish on the CVCs moving forward.
Yeah, absolutely. I think it's terrific. And we're really glad to be part of that, of your team, and to be able to have the comp data to understand. And it's really the relationship back and forth that has been invaluable. So anything we can do, just let us know. And thank you for having me today. How impressive. You really are the corporate venture insider.
Thank you so much, Jody. It was really nice for you to share very openly, candidly, all these insights and how you see the industry. So thank you so much.